Last week, Ordergroove held a private executive roundtable discussing the biggest levers we're seeing subscription box businesses use to lift lifetime value and grow recurring revenue. Leaders from a dozen companies attended, and they found it so impactful that we wanted to share it publicly with you here. In this video, we're going to highlight 3 of the biggest growth levers these executives are using to scale their subscription box businesses. We'll also discuss the benchmark performance data to show why these strategies are so impactful. I'm Eric Andrews, Director of Commerce Strategy at Ordergroove. In this webinar, I'll teach you how to model out the customer lifetime value increases that can be driven by prepaid subscriptions, flexible promotions, and subscription bundles. And if subscription revenue growth is important for your career or business, make sure to follow Ordergroove on LinkedIn and subscribe to our channel. Okay, let's dive in. So just a couple overview slides. I think we're in kind of a once in a generation unit economics moment. Everyone needs to make a lot more money off their customers quickly right now. CAC is in a secular trend going up that will continue indefinitely, based on the supply and demand for ads. There are only so many efficiencies you can squeeze out of your marketing. And subscriptions are obviously sort of the best way you can leverage more profit out of your customers. So, I'm sure you all probably know this, but it's a lot easier to make $50 of additional customer lifetime value than squeeze $50 out of your CAC. But just from a financial standpoint, they effectively have the same impact on your business. And so what we're seeing is that businesses with just the simple sort of subscribe and save 20% strategy are getting okay performance, but businesses that are building highly customized strategies, we're seeing drive customer lifetime values up as much as 2 to 3x versus whatever their sort of month-to-month subscription strategy was before. So we're going to dive into that right now. And what you're going to walk away with today are sort of the metrics and behind the business impact of a couple different ideas, as well as the finance template. Okay, so we're going to talk about prepaid subscriptions, all of the data that we're seeing around the brands that are running prepaid subscriptions and a bunch of different variations. The second thing we're going to talk about is flexible incentives. So that's incentives that depend on which order a customer is in their lifetime. And then the third lever is subscription bundles. So we'll show you the data that we've collected internally around sort of what we're seeing on the subscription bundle front. Okay, so first off, we're going to be talking about all of these concepts, economics framework standpoint. Unit economics, I'm sure most of you probably, does anyone here not think about their business in terms of unit economics? So yeah, unit economics basically tells you the revenue, the profit, and the marketing associated with your relationship with one individual customer. And the biggest thing that we're trying to optimize here, with our products at Ordergroove and with these strategies, is to just drive a larger wedge between the customer lifetime profit and the customer acquisition cost. So the more sort of LTV minus CAC we can drive out of each customer, the larger the operating cash flow of your business will be. And so, if you can expand your customer lifetime value by 25%, and grow your revenue by 25%, the profits of your company will expand by 50%. And so we are sort of laser focused on unit economics because it exposes, first off, a lot of dynamics which defy intuition. A lot of times you think one thing will happen and the opposite happens, and unit economics can kind of expose that story. And the second thing is unit economics are great for modeling out scenarios that you haven't tried yet. And so that's what we'll sort of do in the second half of today's session. So it's pretty interesting. Prepaid subscriptions, I would say, are probably the single largest lever I see emerging in the subscription space right now, where the customer behavior sort of completely defies how I intuitively thought that these would perform. So I want to talk to you a little bit about what we're seeing in terms of LTV lift and also customer adoption. So prepaid subscriptions are obviously where customers prepay a certain number of orders, could be 2, 3, 6, 12, in exchange for a better discount. and then they can receive all the product at one time or over time. There are different ways to do this. It's also a great strategy for gifting, especially like in the beauty space. We see like, gift a year of beauty to your mother, and you can sort of do prepaid subscriptions sort of in a gifting format, which we see works really, really well. And so the data that we actually are finding internally is, first off, a customer on a prepaid subscription generally spends about 150% more than a customer that's on an order-to-order subscription. And in some of our edge cases, we see sort of sometimes 5 to 10x more on these prepaid customers. In terms of adoption, I think this is the stat that really shocked me. If we look internally at all of our merchants, after launching prepaid subscriptions, our typical merchant sees between 22 and 33% of their customers move to a prepaid subscription. So these numbers are significantly higher than what we expected. And again, we have some merchants that are over 50%. And so if you can create the right offer for customers, they actually really will choose prepaid subscriptions over other deals. If 33% of your customers are spending 150% more, the total revenue increase of your business would be 50%. So we're seeing some significant revenue lifts via prepaid subscriptions. There's some additional benefits, which is that it mitigates credit card expirations. Usually 2 to 3% of the credit cards expire per month when people prepay. You can a lot of times save a lot of involuntary churn. And so that works great for businesses that have sort of like long frequencies between orders, long time periods between orders. And then the other thing is, if you can sell a long prepaid, it sort of flips your working capital dynamics. So instead of having all of your cash tied up in your inventory, customers will pay you the cash up front. And if you have a long enough cycle, you can actually manufacture the inventory with the customer's money and then fulfill it to them down the line. So it can actually change the liquidity dynamics of your business pretty significantly if you have longer prepaids and you have strong adoption. So I think that's a really, really interesting benefit of prepaids. So a couple of the main things we hear from brands before they sort of launch prepaids is like, customers, they don't want this, they don't like this, based on the adoption, up to a third of customers are adopting this. Customers do want this, they're happy to prepay for a better discount. And another common thing that we're hearing is like customers can't afford this, the economy, or it doesn't work with our product because it has a higher AOV. And actually our most successful prepaid brand is one of our most expensive products. They have 58% of their business on prepaids. But the customer behavior, it just shows that this is, it's like a little bit of a silver bullet in terms of the subscription space. It's pretty interesting.
If your brand is looking to drive recurring revenue by launching or offering e-commerce subscriptions, Ordergroove is designed to deliver unmatched customer experiences that extend customer lifetime value for ambitious, fast-growing merchants with large order volumes. The leading brands in the e-commerce space have chosen Ordergroove to power their subscriptions, including companies like the Dollar Shave Club, L'Oreal, La Colombe, PetSmart, and many more. If you're doing over $1 million in subscriptions and need advanced capabilities like prepaid, memberships, and bundles, or if you're on a homegrown system and want to lower your technology costs and innovate faster, come book a demo with us to learn about how you can take your customer retention and recurring revenue to the next level.
Okay, so now let's talk about flexible incentives. Flexible incentives are what we're basically calling like, pay-as-you-go subscription, but different orders have different incentives based on where the customer is in their lifetime. And so, you basically, when brands switch from sort of a flat incentive, like, okay, subscribe and save 20% off, and customers just have that, the retention is fine, but when the incentives stack over the customer lifetime, the loyalty is much, much higher. You get far fewer people who are sort of gaming the subscription, subscribing and then canceling, etc. And so usually what we find is that increasing incentives over the customer lifetime with like gift with purchase, etc., can increase your LTVs by between sort of like 10 and 50%. So I want to walk you through some of the strategies that we're seeing work really, really well. we pulled up the product page of a company called Fire Valley Tea. The co-founder of this company is actually president of Shopify, so they just have a really great website. Common sort of flexible incentives are things like 10% off the first order, 15% off the second, 20% off the third. That's basically, it's a tea company. That's basically what they're doing here. But you can see they've created this really cool visual that shows like order one, like certain percent off, order two, like slightly higher percent off, order three, order 4 plus, and then order 5, you see you get like sort of 20, I think it says 25% off plus the gift with purchase. And so when the customer's going to decide like, oh, should I subscribe or like, should I buy sort of one time? If you can communicate it right, then the customer has, many, many reasons to continue the subscription. And if you can roll these out, we generally see just much, much longer customer lifetimes, because by the time they get to order 3, order 4, order 5, they can't get that deal anywhere else sort of on their first order. And so, we recommend that people sort of think about how do you get customers to stick around at the tail end of their lifetime longer. I just want to also mention one last point on sort of gift with purchase versus discounts. I think this is like a super interesting subject, because depending on what your gross margin profile is, like gifting is like more or less profitable. So if you have a product that's really cheap to manufacture, let's say a customer pays $100, but it costs your business $20 to make the product. Well, if you give that to the customer, they just got $100. Whereas to the company, it only costs $20. Whereas if you were to give the customer a $100 discount, it also costs the company $100 of lost revenue. So gift with purchase is a really interesting way, and just gifting in general, to, if it's on the first order, to reduce your CAC by being able to give the customer a lot of value that actually doesn't cost the company very much money in product. And then on the retention side, sort of, if you could give customers twice as much product, and to them it's worth twice as much, but to the company it might only cost 10 or 20 more dollars. So I think it's a really, really interesting way to give customers value and sort of like manage the retention in the CAC. Okay, so let's talk about subscription bundles. So I think everyone here probably knows that, customers are already bundling. If you haven't launched bundles already, we see across all of our merchants that our average customer already has 1.7 subscriptions per brand, and they're kind of hacking it together on their own, even when they're not buying bundles. So customers like bundling, whether you make it easy for them or not. Generally, customers who buy bundles are spending like 60% more over their first 6 months versus customers who are not buying bundles. Obviously, you get some advantages on the COGS side because you can fulfill multiple things sort of in the same order. So you can afford to give a slightly higher discount. So, that's a great sort of advantage for the business. And then there's a few different types of bundles. We're seeing a lot of success with fixed kits, build your own bundles, and then rotating clubs. So if you can just jump to the next slide. So obviously fixed kits are where you have set bundles. Build your own bundles are where the customers can sort of like put everything together how they want. And rotating clubs in particular are super interesting, because you can surprise customers and create delight by sort of curating different products for them. But you can also target moving inventory that's not currently moving. So it's a great way to manage sort of like slow moving SKUs as well, to sort of like get that moving throughout your business. And then our final slide before the break, I just want to highlight just a couple bonus things that are sort of outside of these 3 areas. But just in terms of like the product page, we see that brands that default to subscription, if they're not defaulting the cart to subscription, see about 114% increase in new subscriptions. Putting the subscription offer above the one-time offer, which you can see in this little visual to the right, leads to a very, very large increase in new subscriptions as well. And then certain formatting things like putting the sort of offer in different colors, adding a box around the subscription option, and also doing the strike through on sort of what would have been the price if they hadn't subscribed. All of this stuff can sort of drive your new subscriptions up significantly. So if you're not doing these things, I would definitely consider doing them. So we just want to show you some of the math behind how we're trying to search for ways to increase the LTV. This is what we're doing. Angela can speak to this, but on the customer success side, like we're doing these analyses with our merchants to try to figure out what will it look like based on sort of our benchmarks if we roll different things out. So I want to walk you through kind of a case study to help you sort of understand the really the unit economics dynamic. So please interrupt with any questions. So for our example, we're saying that this is a company that has an average order value of $81, is running a 20% off subscribe and save program. Their product COGS are about $18, fulfillment COGS $12.50. So their total COGS are $30, profit per order $35. So that's the sort of single order unit economics. And so I want to show you in these three scenarios, sort of first off, with their pay-as-you-go subscription, sort of like what are their metrics today? And then if they were to launch different incentives, flexible incentives, bundles, as well as prepaids, what is the overall impact on their business if we sort of move different customer segments into each of these strategies? So for our customer, we're basically saying that these are the dynamics: $35 of gross profit per order, $50 CAC. So on that first order, you lose money, but obviously on the customer lifetime, you pay back that CAC and you make more money. So we have a full model that sort of models out the overall dynamics, but this is the retention curve that we're seeing with this customer. So 100% of customers obviously make the first order, 40% make it to the second order, 25 to the third order, 17.5 to the fourth order. And this is how we think about retention more in terms of cohorts rather than churn rates. And so by the 10th order, you only have 3% of your customers left, and your average customer is making 2.3 lifetime orders. So in this scenario, and these are dynamics that reflect a lot of merchants in certain categories, the lifetime revenue is $150, the lifetime value is $81, and the CAC is $50. So our LTV minus CAC, so the 81 minus 50 is $31. And so we always try to establish our baseline to say, okay, how can we improve the baseline numbers? So here's our starting point. So any questions up to this point, because we're about to jump into prepaids and sort of like what we see on the prepaid front. Okay, so prepaids. So in our baseline scenario, we're saying subscribe and save 20%. And with our prepaids, we're saying we're doing a short prepaid, which is a 3-order. Certain categories work really well with 12-order prepaids or even longer prepaids. But we're saying this is a short prepaid. We're saying prepaid 3 orders and receive 30% off. So from a financial standpoint, obviously your COGS are the same. So your gross profit per order drops from 35 per order to 27 per order. So you lose $8 of profit. So the question is, how much can I increase my customer lifetime? Can I actually make more money giving a bigger discount? And so these are the types of retention benchmarks that we are actually seeing inside of our merchants businesses. So prepaid is interesting because if you think about the retention, you basically have these 100% blocks of time where you have 100% retention. So if in the normal pay-as-you-go subscription, by order 3, you only have 25% of your customers left. Well, on a prepaid, you still have 100% of your customers at order 3. And if you offer a 6-order prepaid or a 12-order prepaid, you have these 100% retention rates for these very long periods of time. And it produces incredible financial dynamics. So these are sort of conservative benchmarks. So what we see is at least 50% of people that come out of a prepaid re-enter the same prepaid. So you see 100% retention for the first 3 orders, 50% retention through the next 3. And so if you sort of just look at the first year of a customer's lifetime, our 3-order prepaid customers generally purchase about 5.7 times over the first year. And if they're on longer prepaids, they buy even more. So in that scenario, we're making $8 less in profit per order. But because we increased the lifetime orders by 146%, your lifetime profit is still up by 89%. And so this can totally change the dynamics of your business if you can move a segment of your customers into prepaids, because the adoption benchmarks, like we said, when I first joined Ordergroove, I expected, I don't know, 5% of customers would do prepaid, 10%. And what we're seeing is about 1/3 of customers move into prepaid. So if 1/3 of your customers increase their lifetime value by 89%, it has a tremendous impact on your sort of operating profits and your gross profits after marketing. So this is the dynamics that we're seeing with prepaid on the shorter prepaids. Okay, so the next scenario I want to show is flexible incentives. So our business originally is running this sort of subscribe and save 20%. And so we're saying, well, what if we switch to a 20%, sorry, I've got to update this, a 20%, 25%, and then 30% situation where from the third order plus, now we're giving people 30% off. And so again, a lot of, founders will look at this and they'll say like, I don't think I can make more money doing that. But what we really need to figure out is, can we extend the customer lifetime enough to make back that loss in revenue? And so you can see here that we go from a gross profit of $35 per order to $31 to $27. But if we can extend the customer lifetime by, half an order or so, you can usually make more money. So what we're seeing in this scenario, and this is modeled kind of conservatively off businesses, the kind of lifts we see, is that they started out here at their baseline as 2.3 lifetime orders or higher if you're in a different category. By just increasing their retention a little bit on an order to order basis, we can get their customers to 3 lifetime orders. And if that's the scenario, we ultimately would see a 19% lift in their customer lifetime revenue, and actually their customer lifetime value would jump from $81 to $90. So that's an 11% lift. But if your CAC stays flat, an 11% lift in your LTV produces a larger lift in your LTV minus CAC. So any additional lifetime value is pure profit. If you can just acquire customers on that first order at 20% off, there shouldn't be really a difference in sort of the customer acquisition cost because they're getting the same deal on the first order. And so those $9 additional are straight LTV to CAC. So that could increase the profitability of your customers post-marketing by 29%. So a lot of this unit economics is like, optimizing these very small numbers across your customer base. Any questions on this before I go to bundles, and then we can kind of bring it all together in a sandbox so you can see the overall impact on the business. So finally, bundles are interesting. So we have a case study with one of our merchants. It's a public case study with Kind Bars. And when they launched bundles, they saw a 24% AOV lift. So we're assuming the same lift for our business. I know a lot of you already think bundles. But in our scenario, we're saying that AOV goes from $81 to $101, and we're giving a 25% discount. Just subscribe and save 25% versus the original 20%. So our discounted AOV ends up being about $76. And the interesting thing about bundles is your COGS don't, because you get some efficiencies on the fulfillment side, because you can fulfill more stuff in the same order, you get a slightly improved gross margin. So you can kind of give some of that back in a discount and still make the same sort of gross margin as a percent of revenue. So that's another really interesting thing about bundles. And so we're saying that the COGS goes up 19%, not 24%. So we're saying we get like basically 5% efficiency out of our COGS. And so our gross profit here ends up being $39.9 versus the $35 per order based on the higher AOV. So here's the thing about bundles that's sort of like unintuitive. That's really, really cool. If you assume that your CAC stays the same, so maybe your customers choose a bundle, they spend 24% more, and that your retention stays the same as a subscribe and save 20%. The increase in your lifetime value, again, if you can keep your CAC flat, all that profit, all that additional lifetime value is just pure profit. And so it can expand your LTV minus CAC dynamics, we're saying in this scenario by 36%, an adoption of bundles we see as like, can be as high as like 30-40%. And so if you were to launch prepaids, flexible incentives, and bundles, I just kind of want to show you the totality of what that could mean for your business. So here we have a little sandbox. And in this sandbox, what we did is we said, okay, our baseline was that our LTV was $81 and our LTV minus CAC was $31, and 100% of our customers, that was their financial profile. But we just modeled out some different scenarios, and we want to see what if we moved our customers, different customer segments into these different pathways. Then sort of what would our overall business-wide LTV and LTV minus CAC look like? So we pulled in the numbers that we just calculated, and we're saying, okay, what if we moved 25% of our customers into prepaids, which is what the actual benchmark we're seeing. 25% of our customers into bundles, which is lower than the actual benchmarks we're seeing. And then we moved 50% of our customers basically into a flexible and incentive structure that boosted their lifetime orders by like 0.7 orders. What this would mean would be that your weighted average customer lifetime value, it would go from 81 to 106, so 31% increase. And again, that's just pure cash flow. And your LTV after CAC would go up by 82%. And so you could drive significantly more profit. And this doesn't account for, new customer acquisition or the revenue growth in the coming years. So these types of tweaks can expand the cash flow of your business massively. And we're seeing this sort of over and over and over again, but you need to get into the really nitty-gritty unit economics to kind of snip out these possibilities.
Understanding benchmarks and how unit economics impact new strategies is key to launching initiatives that can grow your brand's LTV and scale recurring revenue. We hope this video has been helpful. And if you want to learn how your brand can scale customer lifetime value and recurring revenue, come book a demo with one of our subscription experts today. Thanks for watching, and we'll see you in the next e-commerce strategy guide video.